As I mentioned, options buyer is right, and he's getting the right by paying the 100 rupees as a premium. So that obligation goes into the option seller. So if you do the comparative analysis between the future buying and the options buyer, future buyers is obligation. If you bought something and market goes up, you'll get something. If market goes down, you have obligations to pay. In options, if you are buying in options, paying the premium, and if market goes down by 500, 700,000 points, no obligations, because the obligation shifts to option seller or the call seller in an example of 11,900 call at 100 rupees. In the futures, your risk is unlimited, reward is unlimited, and market always first look at the risk part when we are talking about margin. So in future, higher margins, but in options buying, lower margin, because when you're buying this 11,900 call at 100 rupees, whatever be the market on the downside, your risk is maximum 200 rupees multiplied by the 75. If you bought one note, 7,500. So in the options buying, the biggest advantage for the people, and that is the reason that many retail participants are also entering, because only the 7,500 is the required if you are expecting market to really move up. No need to buy a future. Only difference is in future buying, your profit will start immediately after the buying price of your future. But in options, if you are buying a call of 40 plus strike, you have to pay the premium, and after the break even, your profit will start. Future usually preferred by speculators and arbitrageurs, but options preferred mainly by the hedging. When someone has short position on the market, he buys the call to hedge the same. When someone has the long position in the market, he buys by buying the put to hedge the long positions. But sometimes options can be used for other activities like speculations or arbitraging, but mainly options were made for the hedging activity in the market. Long hedge means buying a put, means you are having the long future positions. You want to hedge to the options, buy the put. When you are having the short position into the underlying, in the nifty, let's say, or bank nifty, you need to buy the call to hedge your position. So hedging means if market goes on the other side of your expectations, you are not losing unlimited. Your loss is being limited to some protection of the options activities. So in terms of hedging, your options are like an insurance which you buy and you avoid the unlimited risk scenario to happen, because option seller is similar to the insurance seller, ready to take unlimited risk because he has more probability to just get the benefit of time decay. When you're buying the future, you are having unlimited profit, unlimited risk. But in options, risk is limited or reward is unlimited if you are option buyer. In option seller, that is opposite. But in terms of option buyer, your reward is unlimited, but risk is limited when you're options buyer, whether you are call buyer or the put buyer. Now look at the margin, and margin understanding is very important. What is the margin? See, when you're trading into the cash market, even in the last session also we discussed the difference between the cash market, future market, and the options market. In the cash market, you need to pay the entire value. Now let's say I'm buying 500 shares of a stock which is trading at 1,000 rupees. So quantity is 500, price is 1,000. I need to pay the 5 lakh rupees. But when you are trading the same in future, you can buy only in the lot size. Let's say 500 is the price, or 1,000 is the quantity. 1,000 we can understand about the lot size. So no need to pay the entire 5 lakh rupees. You just need to pay 20-25% as a margin. So by just paying 1 lakh to 1,25,000, you can get the same exposure of 5 lakh rupees kind of transaction which you get in the cash market. So when you trade into the future, you need to pay the margin. So in the theoretical language or the layman language, the margin is a percentage amount of the trade that one need to have in his trading account to enter into a future contract. When you buy in options, that called the premium. But when you trade in future, you need to pay the margin, that is called the margin amount. And margin means some percentage of the total value to avoid any kind of risk if your price moves unfavorable to your preferred scenario. So just to understand that, in example, we can think of it: deposit some amount with landlord would collect from his tenant. So landlord usually connects some deposit from the tenant at the time of signing the contract. Why? Just for safety. As long as the contract is in force, the deposit stays with the landlord. The deposit ensures the tenant doesn't default when it comes to rent payment. And usually you must be knowing, if the rent is 20,000, the landlord takes the 1.5 to 2 lakhs as a deposit. That is for the safety. If something goes wrong at home and if you go to default of the rent payment, he just forfeit from your deposit amount, and he'll debit and credit and do the adjustment of your the transactions. Similarly, margin ensures that none of the parties get away from the owner in the contract, because when someone is buying, the other party is losing. So from the exchange point of view, one party is at loss. So that's why the exchange is clearing corporations. They're clearing all the adjustment of their derivatives market. So when you're trading in the platform of exchange, the clearing corporation take the counterparty risk to get the clearing or to pay the clearing. Now looking at the margins benefits, margin also acts as a leverage. For example, if you are buying one lot, let's say 300 quantity for Asian Paint, and one need to pay the 1,30,000. So only by just paying 1,30,000 rupees, you can buy the 300 quantity of Asian Paints. So just that is only 1/5 exposure of your entire value. But in terms of options, if you're a buyer, you just need to pay the premium amount. Like just for an example, in Nifty we discussed. If you are buying one lot of Nifty at 11,900, the lot size is 75. You need to pay around 1,50,000. But when you are buying one lot of 11,900, call it 100 rupees, you just need to pay 7,500 rupees. So that is the biggest difference in terms of the margin and investment for the option buyer compared to the future buyer. But in option seller, you need to pay the same margin which the future buyer or future seller pays. So guys, that's all from my side on the intro of the options. We discuss about the call buying, call selling, put buy, put selling, the individual payoff, scenario analysis, the difference between future and the options, and at the end we discuss about the margins, how the margins are being calculated, and derivatives is a leverage product. Just by paying the small amount of money, you can take exposure of the multiple money. So the main difference between the cash market and the future market is in cash market, you need to pay the entire value, but in future, you just need to pay some amount of the margins. Option is a beautiful product. If you know it very well, you can customize the strategy as well. When you trade into the market, especially in derivatives, the money can be made just by taking the calculated risk and when you're disciplined. But the good part for the option is the product is already disciplined, because if you're buying a call options, the risk is limited to the premium which you are paying, but reward is unlimited. But one also need to understand, when you're buying an options and underlying remains there, your entire premium may collapse and go down to zero as per the property of the options. So option trading is very interesting. You can customize this. You can just take the speculation move as per the market momentum. And good and best part of the option is you can use that for hedging of your portfolio or to the future leverage position into the market. So guys, thanks for watching. Happy learning. Have a great time. See you soon in the next videos and learning session. Thank you.
Register for our free webinar. Download our app today. Link in description.